Hi, I'm Patu from freefincal, and you might have heard that Divan Housing Finance Limited has not been able to pay an interest to the amount of 960 crores to about 165 mutual fund schemes across 24 AMCs as LiveMint reports, and many schemes have seen a huge crash, the so-called vertical drop in the NAV. If you have checked it yesterday, well, there are many reasons for this, and it's not something that's new. The bad news, particularly with respect to DHFL and in general to all non-banking financial institutions. The bad news is not new. It started last year, as you would know. Um, so let me not get into what is happening, why there is a problem, and so on. So, but we will talk about specifics. If your mutual fund has been hit because of this, what should you do, and what is the way forward? So, I've talked about credit risk in mutual funds in many of my previous videos. I recently talked about the SMP crisis as well. And I just wanted to, before I talk about specifics, I just wanted to show you this. This is the share price of the company, and you can notice that in mid-September 2018, the prices virtually crashed and it never got up again. This crash, as reported by the Economic Times, was because of a bond default concerns. They had problems. At that time, the Ireland FS was also going through problems, and the market was worried there about the connection between these two companies and so on. At that time, who gave this? The CEO, I don't remember. If you read this, I will leave this link below. You can see that they said they have enough money here. There's no problem about meeting payments and so on. And what has happened now is that they have not been able to pay this 960 crores of interest, and they claim a delay in the payment, and they will be able to pay within 7 days, and there are now reports that they will be able to pay on Monday, etc., and so on. Well, D starts delay starts with a D, default starts with a D, and I think all defaults start with a delay. And typically, so I mean, let them pay, then we will see. So if your mutual fund has been affected because of this, if your debt mutual fund or arbitrage mutual fund, I don't know, they could be there, has been affected by this, don't do anything for the next few days until there is clarity about whether the money is going to come or not. It may come, it may not come. Even if DHFL pays back the full amount, still the price of that bond in the market may be affected. It can come down because of concerns again. The credit rating can also go down. I haven't checked what is the current rating, or it should be affected already, if I'm not wrong. But the credit rating will not come back to its original value. So if the NAV fell by 6% or let's say 3%, it will not go back up the full 6% or 3%. It will go back probably about 75 to 80% of it, roughly. That's my estimate. So in situations like this, when there's a delay in the interest payment, when the bond is secured against some collateral and so on, then the AMC will, if the AMC is holding, let us say 1%, 75% of that holding they will mark down. If there is no collateral, they will mark down the whole thing as zero. That's why you can see the kind of fall and compare it with the weights that they have been holding in their portfolio. So it will not go back up the full amount, but it will go back to about 75-80% roughly. But so there will still be a loss. You cannot escape that loss. Once there is a delay in the interest payment, there will be some kind of loss. It will be a small loss if they pay back within the 7 days or by Monday or whatever. They'll have to. But the point is, the problem is that AMCs have been playing with fire, and they should have got out of such bad bonds a long time back. But AMCs have been playing with fire, but they are playing with fire because their livelihood depends on it, because they need immature investors who want more returns than FD, and the distributors do not educate them, and that's why they're playing with fire. But I mean, if your debt mutual fund has been holding such bonds in spite of this bad news, then you should not be surprised and say, "Oh, what happened? I've been cheated," and so on. Don't say all that. You should not be surprised. This was going to happen. I mean, look at that. Market decides the value ultimately. Okay, there was a crash because of some kind of knee-jerk herding reaction, but it never went up. It never went up because the market senses there is problem. There is a problem in the whole sector, not just this company. So it should not be surprised by this news. And so the first thing I want to say is, if you have been affected by this crisis, don't do anything until there is clarity on whether the money is going to come back or not in the next few days. Then the NAV will recover to some extent if it comes back. If it does not come back, then the AMCs will probably decide to side pocket the portfolio. That is, they will take all the good part of the portfolio where there is no bad bonds like this, and that portfolio will have a separate NAV, and the other part they may decide to keep it away, and you may not be able to redeem that portion of the portfolio. They'll wait for the company to give back the money and then only give it back. As far as I know, that's the rule. I don't think you can redeem that part, or maybe there may be an option for you to get out fully also. So this portion, the good NAV will you can transact as usual. But if the fall is too high, then most mutual funds may also close it for further subscriptions, and especially if they're side pocketing, I think they will close it for further subscriptions. As far as my understanding goes, I could be wrong, but I think that's my understanding. Let's see how this develops. So don't do anything until there is clarity on this issue. And once there is clarity on this issue, you can take a call. My suggestion would be, if they are not able to pay back the interest, pull out the money. You're lost. You gained some experience. You lost some money. Doesn't matter. Just get out. But next time, be careful where you invest. Do not chase returns in mutual funds. Do not, for God's sakes, do not look at those bullshit star ratings. They're crap. How many times? Nobody is saying this. This is the problem. How many times will I say, don't look at those crappy star ratings and invest? You will suffer because star ratings cannot take into account credit risk at all. They will react to it only after the fall. Once the fall now has fallen down, next month if you look at the star ratings of all these funds, they would have all gone to, they will drop by 3 or 4 stars. If they're 5 star, they'll almost become 1 star immediately. But just bullshit. Don't look at all this and invest, and don't take credit risk explicitly. You see, if you are going to buy a credit risk fund, or if you're going to buy a fund where they invest in A bonds or AA bonds, then you should not cry. You can cry if they have invested only in AAA bonds and then it defaults. Even then that has happened. That happened a few months ago, right? So at least that is a little better than this. This, I mean, it was just a matter of time, and the time has come now. So don't do anything now. Wait for some clarity, then take a call. My suggestion is, once they side pocket, or even if it recovers back to some extent, get out. You lose some money, it's fine. Get out. That's it. So that's that. Now I want to show you I'll show you an example of why there will always be a loss once there is a fall in the NAV. The problem is, these reporters, many of them are just illiterate. They say, stay invested until this happens with the Z bonds. Forget the name of the company. This happens a few months ago with the Z bonds, where the AMFI decided to, the FMP crisis, where the AMFI decided to, agree to, wait until September for all these things to clear and so on. Then HDFC rolled over the FMP. Then many reporters said, wait, let the FMP get rolled over. You will get your money back. You may get your money back, but that's not the point. You will still be in a loss in terms of return. So there will always be a loss. I will give you an example for this. This is a slightly dramatic example, but it does help you prove the point. So what I've done is, I have taken 2 debt funds, a good debt fund and a bad debt fund. And what I've done is, you can see here. So let me make this bigger. And make this bigger. Here you go. So you can see the NAV from day 0, and for about 3 years I've shown the NAV. And you can see after 1 year, the NAV of the bad debt fund falls by about 10%, and then that's the bad debt, but the rest of the portfolio keeps increasing. I have assumed a steady increase of about 9% a year, and I've divided that to daily increments and I put the constant daily increments, there's no market volatility that you see here. I have assumed that this is a 9% kind of debt fund, so they have taken on credit risk. That's why you have that debt. So you see that there's a good debt fund and a bad debt fund, and both of them have the same annualized return of 9% here. That's of course an imagination, because both funds, they are chasing after that much returns. Both of them will be susceptible to credit risk, but just for the sake of illustration, bear with me. So after 1 year, the bad debt fund has crashed by 10%, but then the rest of the portfolio keeps building because of the daily interest payments. It will slowly, the NAV will keep moving on, and then it keeps going. Of course, the rate of increase of this and the rate of increase of that is the same at all times, aside from this vertical drop. Now, if you look at the returns, I plotted the annualized return. I don't see the. Excuse me. I don't see the. Where is the x-axis? Have I done something to it? This Excel is a little tricky. There it is. Okay. So now you see the annual returns. So it's always 9% because that's what I've set it. And before the crash, it's 9% for both funds. The good debt fund will always have that 9%. That's, I've called it good CAGR here. That's always going to be 9%. It's a steady line. But look at the bad CAGR, or that corresponds to the bad debt fund. There is a crash, and look at how much the CAGR drops. Of course, it's a very dramatic example. It will not happen to your investments, but it will reduce definitely. And notice that the CAGR is recovering, but it recovers slowly. This is steady, and it will take a long time for this CAGR, assuming there are no further defaults. How long this red line will go and catch up? How many years it will take to get to that 9% line, imagine. So even if you get back your money, because of the time value of money, you will always be in loss. Don't say, I got my money back. No, you lost. All that loss is permanent. Once the NAV drops, vertically or otherwise, there will always be a hit in your returns. So don't just say, first of all, don't invest without knowing risk and then be satisfied that you got your money back. Assuming you will, I don't know. So that's what I wanted to convey in this. You should not, if you are taking credit risk, you should not be surprised about these events. You should take them in your stride and move on. If you do not want credit risk, then the options for you in the debt mutual fund space are becoming narrower and narrower and narrower with each passing day. Arbitrage funds are no longer safe. Liquid funds are no longer safe. Ultra short-term funds are no longer safe. Money market funds are no longer safe. Maybe one day money market funds will also come. So you cannot escape this. If you do not want this, then you have only one choice. You must stick to long-term gilt funds and suffer the daily volatility, or in long-term gilt funds, the NAV will keep on sliding like this down gradually for months and months and months and months. Again, you will have this kind of a CAGR problem. The annualized return will keep dropping, but there will be no vertical drops. So wherever you go, as the saying goes, you can run, but you cannot hide from risk. Risk of some kind will always follow you. It's only a matter of knowing what those risks are and how to handle them depending on the circumstances. So thank you as always for listening, and I'll catch you in another video. If you have any questions on this, please let me know. Bye-bye.